Hello, everyone. Today is Friday, the 20th of January, 2012, and this is Brian Shannon from Alpha Trend speaking. Let's go ahead and take a look at these markets here. We had another strong week for equities. If you take a look at the tables here, the S&P closed up about 2%, Nasdaq 2.7%, and the semiconductors really pulled away, up 6.5%. They've been our leaders so far this year. We noticed that early on, and they continue to lead the way. So the semiconductors remain an important benchmark for this market. More so, I think, and I have said in the past, than the financials. But the financials have exceeded their 200-day moving average in the trend line. We'll take a look at that here in a moment. But the S&P 500 for the week, again, up 2% as this rally continues to get a little bit more extended. And we've been warning about, the market's now up about 9% off of the December lows. And it's gone, pretty much straight up. I mean, there's been some time consolidation along the way, but we've gone beyond every level that people have called resistance. And as I pointed out yesterday, the market continues to show us why no one knows what resistance is until after the fact. Resistance is a level where prices are halted on the upside, where the supply offsets the demand that's coming into the market and prices stall out and the upward momentum fails to follow through. Well, we haven't had any real resistance yet. Not at this high from mid-October. We paused there briefly, and not here at this trend line as well. These are potential levels that we always want to be aware of. The inverted head and shoulders pattern that we had observed and had broken that neckline at the first of the year still measures out to 138. And while that may seem far-fetched, if you look at the Nasdaq, with a close of 59.77, the highest close was back here last year at $59.60. In order to see where we close this high, you have to go back to the monthly chart, and it wasn't since January of 2001 that we've closed this high in the Nasdaq on a weekly basis. So we're at 11-year highs basically in the Nasdaq 100, and this market continues to chug higher, very impressively without one of its big leaders, at least psychological leader, that being Google. Google, as we know, had that breakout earlier in the year, and it looked like it was going to maybe be able to lead this market. Well, from that failed breakout, we've had a fast move lower, down now to the 100-day moving average. Is that, again, that breakout failed, and it's not the breakout that matters, but the subsequent action. And we want to always see that when a market or a stock breaks out, that it's able to hold above those key levels, which is why we've been emphasizing in the S&P 500 and these other markets that the key is, yeah, we're extended and we're touching trend lines and that sort of thing, but as long as we remain this pattern of higher highs and higher lows, and in particular as long as we remain above these key levels of support, which we keep doing, then the intermediate term trend remains innocent till proven guilty. That's the theme we've had going since the beginning of this year, and there's no reason to think that that theme should change. We do always have to be aware, though, that the market's expended some good energy getting up to where it is, and some kind of pullback along the way would not be unexpected, but perhaps we're headed up towards that 135 before we see a meaningful correction. We've got a healthy market, and let's take a look at the 10-minute time frame. Early next week, we're going to want to see this afternoon's lows, and basically the lows from Thursday as well, from the regular session at about 130.90. Those are going to be our important level initially. So far, we've been holding above each day, each beginning of the week's high. That is, we closed above the Tuesday high this week, and we've continued to be able to do so. So 130.90, and then we've got the 5-day moving average just below that is also potential for some support if this market does pull back. Now, the Nasdaq 100, as we know, had broken its downtrend line. It's kind of similar to what we're drawing in the S&P 500. We had this prior resistance that held as support early on, just last week. We broke this downtrend line and have continued to move higher, and again, up to what are now very close to 11-year highs in the Nasdaq 100. Here's another market that's definitely getting extended, but anyone who's trying to pick a top based on it being extended continues to get hurt. And in the S&P 500 today in particular, it was choppy, but we had a super strong close here with the market rallying. Well, not super strong, but a nice 30-cent rally in the SPY here in the last 20 minutes of the day or so. But back to the Nasdaq again, trying to pick the top doesn't make any sense. What we want to do is see if prior levels of resistance continue to hold. So next week, I think that, probably 58.5 to 59 is going to be a key level for the Nasdaq to hold. Very short term, we have 59.5, but I wouldn't be surprised if we lose that and head down towards about 58.5 initially, just because a lot of times when we break out to these new highs, you have to ask yourself again, where have we come from? And with this market coming a little more than 10% off of the December lows, is now the time to buy the breakout after an extended run. It might be, but what we have to do is say, as long as we remain above these higher lows, then the uptrend is uninterrupted, and we give the benefit of the doubt to the buyers. Perhaps we'll see some time correction, but as long as we hold the higher lows, the buyers remain in control. The Russell 2000 had obviously a good week as well. We've been talking about the 200-day moving average in here, and first it was the 150-day moving average that we had broken above and held above, and then we got above that 200-day moving average in the early October highs. That level is held very well, and the key levels we've been focusing on were the potential, and weeks ago we were talking about potential resistance, was this, the lows that became resistance in that 77 to 78 area. I'm sorry, 76 to 77 area. This prior support, which did act as resistance, so far has not acted as resistance once again. We've instead blasted right through there, and the market continues to act strong. So the Russell 2000 is definitely just got that all messed up. But the Russell 2000 continues to behave very well. It's got this pattern of making these important higher lows on each week that we see going forward. Early on next week, we'll want to see about the 77, 80-ish level. We'll want to see that hold. And, if that fails to hold, then I think maybe a little bit further pull back down towards 77. But the bigger picture is still higher highs and higher lows above key moving averages. Semiconductors, again, were the real star this week, and they had been early on leaders this year as they had broken this little high, held above that 50-day moving average, and then they had broken the December high where that prior resistance held as support right along that rising 10-day moving average. And it looked as though perhaps the market was going to break down, but instead we had that gap higher. And from that gap higher that we saw just 3 days ago, after this market, it got below the 5-day moving average, but we were still holding that key support at 3150. Well, as it gapped up, it just really has squeezed those shorts quite hard in here. And the prior important level we were looking at in here as potential resistance was that 32 area. 32 was the big level of support in the first half of 2011. It became some resistance earlier this year, or I'm sorry, in the second half of the year, and now we're going on to the next levels, and 34 is the next potential level where maybe these highs and this prior level of importance are going to be the place that offer the resistance. Let me see if I can draw that a little bit better. For some reason I'm not able to grab a hold of that well, but let's just draw the horizontal line in there at 34. So you can see that's been a significant level. It doesn't mean it will become resistance, but again, we're getting a little bit extended from 29 up to 34 basically. We've seen a nice rally, but it continues to act healthy. Now this is probably the most extended market here. Is we gapped up and ran, and now it's just kind of just grinding higher. So a pullback even towards 33 would not be a bad thing for something like the semiconductors next week. And you look at look at a stock like Intel. Intel broke out today, past some resistance, and we're seeing multi-year highs in shares of Intel. We're seeing some of the other big tech names like Cisco. We had observed the breakout here. It's starting to get a little bit of legs to its movement. Microsoft had a big day today, so it's not just about Google. And you look at Google and say, well, what's going to happen? Is this a buyable gap? Personally, I don't like to buy these, but maybe it's going to be like Oracle, or perhaps it's going to be like SHLD, Sears Holdings. It's gapped down, dropped for 4 or 5 painful days, but then had this huge squeeze from 30 to 50 basically. Another stock that I had played for a bounce. I think I got a point or something stupid out of it early this year. Was this IGPG or IPGP? I'm not even sure what they do, but the point is, some of these stocks are really bouncing strong, and we're in a very fertile environment for long side trades right now. People have been talking about the financials and how the 200-day moving average was resistance. It acted as resistance for a while, but we didn't break down from there. It's just it was a temporary stopping point as this market has continued to rally. Now we've broken above that 200-day moving average. Here's our first daily close since above the 200-day moving average since May of last year. We've broken this downtrend line, and we've been kind of focused on this 1420 level that's saying perhaps we squeeze a little bit beyond that 200-day moving average up to the 1420-ish area, and then maybe we get a little bit further pullback. There's no evidence, though, of a pullback. In fact, just the opposite. You saw a tight consolidation the last 2 days after the gap up on Thursday, and then a very strong close here at the end of the day as well. Just a beautiful uptrend here on this 30-minute time frame. You have to look at what's the essence of trend when drawing that trend line. You don't want to go like this because you'll be continuing to intersect. But this has represented the essence of trend, and you can see there's a nice little channel in there as well. But perhaps the financials are headed back up a little bit higher, up towards the 1480 was really the big level, or was it 1460 to 1480? That was the big level of prior support last year. Perhaps we're going to continue to squeeze up through there. The key, as always, is to listen to the message of the market. Let the market tell you, hey, we're holding above key levels of support. We held 1360 this week. That was the key level. Early on, looks like about 1390 is going to be important last week. That's where we had a little bit of resistance. It held as support. So again, we continue to be in a fertile environment for the long side. It's nothing like last year so far, but expect more choppiness ahead. That's just the way the market moves, and don't let your confidence exceed what the markets realistically can deliver to you. Have a great weekend, and thanks for tuning in.